After 5 decades, Chevron, the American energy behemoth, is bidding adieu to the North Sea. This significant move marks the end of an era as the company divests its oil and gas assets in the region. Chevron's decision to sell its North Sea assets, valued at $5 billion, reflects a strategic shift towards more profitable and sustainable ventures. The company aims to streamline its portfolio, focusing on shale gas production in the United States and renewable energy projects globally. The aging infrastructure and declining production levels in the North Sea have made it less attractive for energy giants like Chevron. As the world grapples with climate change and seeks cleaner energy sources, the North Sea's future remains uncertain. Chevron's departure from the North Sea will undoubtedly have significant economic implications both for the region and the company itself. For the North Sea region, the loss of a major player like Chevron could result in job losses and reduced investment in the short term. However, it also presents an opportunity for smaller, more agile companies to step in and capitalize on the remaining reserves. The sale of Chevron's assets is expected to attract interest from a variety of buyers, including private equity firms and smaller oil and gas companies. These new entrants could bring fresh capital and innovative technologies to the region, potentially extending the life of existing fields. Moreover, the North Sea's well-established infrastructure could be repurposed for offshore wind and carbon capture projects, creating new economic opportunities. From Chevron's perspective, the sale allows the company to free up capital for investment in more profitable ventures. The environmental implications of Chevron's exit from the North Sea are complex and multifaceted. On the one hand, the departure of a major oil and gas producer could be seen as a positive step towards reducing carbon emissions and combating climate change. However, it is important to consider the potential environmental risks associated with decommissioning aging oil and gas infrastructure. The process of plugging wells and dismantling platforms can be complex and costly, with the potential for environmental damage if not handled properly. Ensuring that Chevron and other companies adhere to strict environmental regulations during the decommissioning process will be crucial. The region has significant potential for offshore wind power, which could replace a portion of the energy production lost from oil and gas. Investing in renewable energy infrastructure and supporting the growth of a clean energy sector will be essential for a sustainable future in the North Sea. Section 4. Global energy tides, riding the renewables wave. Chevron's strategic shift away from the North Sea is indicative of a broader global trend in the energy sector. The world is experiencing a paradigm shift towards renewable energy sources driven by concerns over climate change, technological advancements, and declining costs of renewables. Solar and wind power are becoming increasingly competitive with fossil fuels, attracting significant investment and driving the growth of a global clean energy market. Governments around the world are implementing policies to promote renewable energy and reduce carbon emissions. The Paris Agreement has set ambitious targets for reducing greenhouse gas emissions and transitioning to a low-carbon economy. Chevron's decision to focus on renewable energy and other ventures reflects an understanding of these global energy trends. Section 5. Chevron charts a new course, a strategic pivot. Chevron's exit from the North Sea should be viewed within the context of the company's broader strategic objectives. The company is seeking to optimize its portfolio, focusing on assets that offer the highest returns and align with the changing energy landscape. While the North Sea has been a significant part of Chevron's history, it no longer fits into the company's long-term vision. The company's focus on shale gas production in the Permian Basin is driven by the region's lower production costs and higher returns. In addition to shale gas, Chevron is also investing heavily in renewable energy and other low-carbon technologies. These investments are part of Chevron's strategy to position itself as a leader in the energy transition. Section 6. Navigating the energy future, policy and investment. The transition to a cleaner, more sustainable energy future will require a concerted effort from policymakers, investors and energy companies alike. Governments must create a supportive policy environment for renewable energy, including carbon pricing mechanisms, renewable energy targets and investment incentives. These policies will help to level the playing field between fossil fuels and renewables, driving investment and innovation in the clean energy sector. Institutional investors are increasingly divesting from fossil fuel companies and redirecting capital towards renewable energy and other sustainable investments. Energy companies must adapt to the changing energy landscape and embrace the transition to a low-carbon future. Companies that fail to adapt risk being left behind in the global shift towards a cleaner, more sustainable energy system. Section 7. Conclusion. A new dawn for energy. Chevron's departure from the North Sea marks the end of an era for the region and a turning point in the global energy landscape. The world is transitioning away from fossil fuels and towards cleaner, more sustainable energy sources. By embracing the energy transition and investing in renewable energy, we can create a cleaner, more prosperous future for all. Let us seize this opportunity to build a more sustainable and equitable energy system for generations to come.